stuff up as I go. It's the same protocol all the time. But there are times where I want to see it close in because I want to see it fail. And that's something for your notes too. The inefficiencies that stay open are going to act like real supported resistance because this is acting as a breakaway gap. Why should I expect this? I know you're thinking, okay, so I get it, ICT, I wrote it down, but why did you expect it to stay open? Because I get this question so many times. And even in the lectures when I talk about it, like I'm doing here, I will still see, I almost said something rude. I probably will. I'm going to publicly shame you. I'm going to screenshot it and put, now, see, you're going to do it now because you want your name to appear on my community tab. But I was thinking, I'm going to shame you and show you that you're asking something I talked about in the very lecture when I talked about the very thing you're mentioning a concern about, which is I get this question a lot. How do I know which fair value gap won't fill in? Okay, if we were in a classroom and I said, okay, raise your hand if you don't know when to do that. Most everybody would probably raise their hand. And I get that same type of thing in the comment section. They'll say, how do you know that that fair value gap doesn't or won't likely close in? Like what gives you that discernment? What makes you say that you can trust that? Well, we've consolidated like this here. And my attention was around this level here. Not enough to take a trade, but I wanted to see, does it repel this and start to break down? Before I go any further on that, if it would have started to break down, I would have dropped down into a 15-second chart, used the fair value gap, and outlined that down into the level I was looking for over here and then here. But it didn't give me that retrace back to it and break down because we're looking at it on a 1-minute chart. Then I could drop down to a 15-second chart and then use that and teach on the price delivery continuum theory. So all that means is, it sounds like mumbo jumbo, but it's basically understanding one time frame and then breaking that run that you see beginning on one higher time frame, in this case the 1-minute chart. I can drop down to a 30-second, a 15-second, a 5-second chart and find multiple entries in that delivery while that price run is unfolding. You're getting lots of opportunities to get involved in that move and still not technically be chasing the marketplace. But there's a threshold at which you got to stop. And if you've seen my lesson on pyramiding, when to stop adding to the trade and making it larger, it's the same premise there. Okay, so you'll see me teach on it. I know some of you are going to get mad because I didn't say it again, but I'm trying not to be too redundant, but there's enough redundancy here to prove that it's the repeating phenomenon in logic. But why did I talk about this staying open before going up into this area here? Because we've traded above the consolidation, all of this right here. Let me do it like this. All this price action here. We've traded higher since 9:30. Here, up, back down, traded higher, consolidating. Okay. I don't like these kind of days, and I would rather wait for more information or do nothing, because on a day that's showing me that it's not trying to gyrate around too much, it's small and compressed. It's a lot of stagnant price action. Whereas when it does finally move here outside of that range, we had the stops below here taken out, as I mentioned, and then we traded above the high. Okay, wonderful. Once it does that, that means we left this consolidation. Did we leave the consolidation after a stop hunt? Yes. So that means once we're outside of this range, and if we have a fair value gap, those tend to be left open. So what does that mean? You can feel, not today, not on a day like this, but you're going to see me talk about it on other days where there hasn't been a big PPI number or CPI number or something to that effect, where we move outside of a range and we have this same element here. This is something you can go back and look at your old charts. Maybe it's a trade idea that you lost on, or maybe you missed a move, or maybe you didn't know what the market was going to do, and you can go back and look at your old charts and see this here, and you'll see that they stay open, not all the time, but most of the time. If it's something like this and you anticipate them staying open, and you have a target up here that you think is going to draw a price to, you can put this candlestick's low, your limit order, right at that candlestick's low. because then it only takes one tick to get below it to fill you long, and then aim for your target. Now this is like a bread and butter type setup where it's not a whole lot of movement, it's not a whole lot of range, but you can see we did trade all the way to the top of that volume imbalance on the daily chart. So this one, for the purposes and exercise of logging it, you want to make sure your charts all the way over the whole real estate of your chart. You don't want to have your charts like this, Caleb, because if I start seeing it, it's going to drive me nuts. The whole chart from the beginning of the move down here to the target, and make sure your chart is really filled up and it's showing you a nice range that we can see the prices over here, and it gives you lots of places where you can write and annotate. Okay, but when it's open like this, you can use institutional order flow entry drills, which is a partial entry into a fair value gap that you believe strongly is not likely to completely fill in. Now, you will see these setups form, and you will enter with institutional order flow entry drill as your entry model, just like any other model, any other entry technique. Okay, but it's a very specific element of anticipating fair value gaps that you believe will not close up or fill in like in here.